So when you get a question of this nature, what can help us to attend to it quickly? Or first of all is to identify the topic. I'm sure you agree with me that one of the most important things is to know which topic am I dealing with here, so that you prepare your mind accordingly. So when we look at the question requirements, they'll tell us the topic. Discuss the possible reasons why V may have switched its strategy of organic growth to one of growing by acquiring other companies. So then we realize that, oh, wait a minute. So this topic here is about mergers and acquisitions. So you now prepare your ammunition, isn't it? You prepare your ammunition accordingly. Because now you have identified that, okay, in terms of the topic, this is the concept of mergers and acquisitions. And the first bit is theory. And this is theory that we have nicely discussed. The reasons why a company may switch from organic to acquisition. In other words, you are saying that we have some advantages. We have some advantages of acquisitions. And even before you read through the question, you have some ideas of advantages why companies should consider growing by acquisition as opposed to growing via organic growth. And you look at the marks, 4 marks. You're saying certainly I'll be looking for 4 points here. I'll be looking for 4 points there. Discuss the possible action V could take to reduce the risk that the acquisition of T company fails to increase shareholder value. Yes, we know that there's a high failure rate. There's a high failure rate. Of mergers and acquisition. It's a well-researched matter. It's a frequent subject in research by accounting students. To investigate why the failure rate is high. And the same reasons for the failure rate give you an answer to this question. The possible actions. What can you do to avoid the high failure rate? So even before you read through, you already have answers to this question and that question. And if you look at these, that's 11 marks. So from the examination strategy point of view, you tell yourself that the passing marks are in A and B, isn't it? And in terms of time that we are going to take, the time to be taken, the time that A and B will take is not compared to what C will take. Now this comes with experience. With experience, you're going to see that what happens that on this paper, the theory questions take less time and they have got good allocation of marks. Very good allocation of marks. In terms of time, they don't take too much time, which is a plus for us. That's a big plus for us. Okay. Now, so A and B are parts of questions where, as students, you can easily find the answers and pick the 11 marks. The part that we want to consolidate together is again the issue of estimate showing all relevant calculations, the maximum premium that V could pay to T, maximum premium. That V could pay to T, to acquire T. Now, in terms of the answer, you all know that what the answer is, you take V on its own, you take T on its own. You find the answer. Then you say the combined. What do we have? We have 120. So this is what you are looking for. This is what you are looking for. A structure like this one. And then the difference become your acquisition premium. So the maximum acquisition premium that we can pay is 120 minus 100 or 20. This is your maximum premium. $20 is the maximum premium. So then, as you approach this question, you tell yourself that I must speak information on what is the value of V, what's the value of T. Now, from previous questions, what have we learned? What we have learned is that some of the values are given. For instance, when we did H and strand, have and strand. Do you remember the question? The share price was given. Do you remember that? And here, we needed to do a P evaluation. So the one was given, the other one, P evaluation. When we came to the combination, we saw that when we combined H and S, what method of valuation was to be used? A P evaluation. So now you start realizing that, okay, so even this question, they may be the same. But as you can see, as we saw in this question, we notice that yes, H and S, sorry, V and T, some information was given, but the combined company was broken down. And this is what we want to talk about. So now let's go into our question. Now, this experience that you have is what you're going to use in the exam. So in the exam, we move in with this experience. And the question of this type has been repeated. Okay, so let's go now. V company, a listed engineering company, manufactures large-scale plant and machinery for industrial companies. Until 10 years ago, V company pursued a strategy of organic growth. So they pursued a strategy of organic growth. And we know that this strategy is quite slow. It's a slow method of growth. Since then, it has followed an aggressive policy of acquiring smaller engineering companies, which it should have new technologies. Have you seen? New technologies and methods which could be used in the manufacturing process. So there's no need of you developing new technologies and can simply acquire smaller companies. So their strategy was looking at these smaller companies which had already these competencies. However, it is estimated that only 30 and 40% of the acquisitions made in the last 10 years, only between 30 and 40 of the acquisitions made in the last 10 years have successfully increased shareholder value. So there's a problem. The success rate is between 30 and 40. And that is why the question says, what is the solution? What can they do differently to increase the success rate? The company is considering acquiring T in an unlisted company which has 3 departments. Department A manufactures machinery. Department A manufactures machinery for industrial companies. Department B produces electrical goods for retail market. And the small department C operates in the construction industry. So this company is a 3-in-1. A manufactures machinery for industrial companies. B produces electrical goods for the retail market. And the smaller company C operates in the construction industry. Quite diverse. Now, what do they intend to do? Take over the whole company? No. Upon acquisition, department A become part of V. So A is the one that we are going to assimilate. It will become part of V, as it contains the new technologies which V company is looking for. But department B and C will be unbundled with assets attached to department C sold. So there's a disposal here. And department B being spun off into a new company called Vogel. So this is a new situation in the sense that after the acquisition, what are we used to? After the acquisition, what we're used to is that we just have one entity. But here we have seen that the only entity that we are going to assimilate is department A. So the question is, how do we approach such a question? How do you approach such a question? Then you've got a lot of values given. So we've got your income statement there and your statement of financial position values there. And we are given information about current assets and non-current assets. So then we need to find the value for C. We need to find the value for B. A, we combine it with the main company. A, we combine it with the main company. So then, what valuation methods are we going to use? Remember, we've got V and T before. And after, we've got department A, we've got department B, and we've got V plus department A. These will continue, will be combined. This one will be, so what's the value there? What's the value there? What's the value? So this is what will give you the value post-acquisition. Before acquisition, you notice that there are no issues. Post-acquisition, C, they are giving us values of C. It's estimated that for department C, the realizable value is not current assets. That one is 100% of value. Current assets, only 90%. The cost related to closing department C are 3 million. Okay. So for department C, how are you going to value? You can see that from the information given here, we're looking at an asset-based valuation. This is an asset-based valuation. This is an asset-based valuation. So then we have got an opportunity to practice what? An asset-based valuation. The funds raised from disposal of department C will be used to pay off T companies other non-current liabilities. The 7% unsecured bond will be taken over by the new company called Indegi. Okay. We continue. Let's continue with the reading. So we have identified that post-acquisition, the value attributable to C will be found using what? Asset-based valuation. The value attributable to C will be found using an asset-based valuation approach. What of B? What method are you going to use? Huh? Let's go. We're going to find the answer together. At present, around 10% of Department B's profit before depreciation, interest, and tax come from sales to C. So, meaning that if C disappears, these sales will also disappear. So it means that the sales there and the profit will drop automatically by 10%. The company's cost of capital. Now, when they're mentioning cost of capital, what comes to mind? It is estimated that in the first year operation, the company's free cash flows, now they have given us a clue. Free cash flow to firm will grow by 20% and then by 5.2. Then you are saying, okay, this company then, we are going to value the component of their contribution using the free cash flow, and this is free cash flow to firm. The tax applicable is given there, 20%. N can claim 10% tax allowed depreciation on its non-current assets. It can be assumed that the amount of tax allowable depreciation is the same as the investment needed to maintain operations. Now you say, yes, Mr. Perry, we've come across this before, isn't it? Remember that routine capex? Routine capex with two components. Routine capex with two components. Okay. One is to grow operations. Other one is to maintain operations. And we have noticed that in our questions there's normally one, isn't it? Especially this one is the common one. This one is normally equal to depreciation. And that's what they're saying here. And this is what we mean experience. You're becoming experienced now because you have seen these items before, isn't it? So then what have we established so far? Just remind you, what we've established so far is we have a situation where we want to know what are the values before. If these companies operate on their own, what is their values? So as we are reading, we want to know, have they given us these values? So far, no information has been given. What of after? After, we have indicated that the structure is that V plus Department A will continue as a company. B will be spun off. And C will be sold off. And so far we have seen that an asset-based valuation will work there, free cash flow will work there, but we're not very sure of what to do there. So we're still investigating. We are still investigating. So let us investigate further to see what method we are going to use. Let us see what method we are going to use. Okay. So remember what is the balance of what is remaining, eh? Remember the balance of what is remaining? Okay. V company's current share price is 3. Now that gives us a clue. Now we have a clue. current, we have a clue. So V companies is kind 3, so we have a clue there. And estimated that T company's price earnings ratio is 25% higher than that of V. So we have an idea then that before that one is given, then here we use a PE ratio. After the acquisition when department A becomes part of V, it's estimated that V company's P ratio will increase by 15%. So we can argue again that, okay, this is clear then. So when V continues with department A, this valuation is going to use a PE valuation. PE valuation is what we're going to use. It is estimated that the combined company's annual after tax will increase by 7 million due to synergistic benefits. Now, this is similar to what we came under H and S. We came across this, remember? Yeah. We are D, the profit after tax, the profit after tax, and then we had some synergy. So we had that value plus that value to give us profit after tax, on which we applied the PE. So even here, we have also some synergy here. And this synergy is the one which is coming in as how much? 7 million. This sort of an analysis, this sort of expectation is one we can take to other questions in our examinations. Okay. So with all this now, how we can quickly get marks is fill in what has been given. Let's fill in what has been given. So what is it that has been given? Let's try to fill in what has been given. Okay. So let's go now. Now I shared the worksheet. So that is the same one that I'm going to share here. Okay, so the starting point. From what we have seen now is that the starting point is we need to have this structure before and after. Before and after. So what do we have before and after? Before, we have now established something. What have we established? Let's look at what we have established. We have established that B has a current share price of 3. How many shares do they have? Let's check here. On the share capital account, they have 190. The nominal value is 50. So 190 divided by 50 gives a number of shares. Which one? 190 divided by 50 multiplied by 3. So that is the first item. So the value of V is 3 multiplied by the number of shares. What of T? It is estimated that T's current price earnings ratio is 25% higher than that of V. So then what is the question saying? The question says you go to V and estimate or calculate the PE. . Let's calculate the PE. What's the formula for the PE? The PE is share price divided by EPS. So you need to find the PE for, and then you just add 25% to get one. Share price is 3. What of the EPS? The EPS is not an issue. The number of shares. The number of shares is given. We know the number of shares is 190. What of the profit after tax? The profit after tax is here. Profit after tax is 158.2. So 158.2 divided by number of shares. Okay. So let us now conclude our case, the first one. So let's conclude our case. Having identified how we proceed, let's now close our case. Let's close the case. So we come here. Let's go. So the value of V is 190 divided by 0.5 multiplied by 3. What of T? Let's follow the value of T. Okay. The PE for V, the formula. That's the first item. Secondly, the share price is 3. What are the earnings per share? The earnings per share is given here. 158.2 multiplied by 0.8 divided by 3. What is 158.2? What is the 0.8? This is the profit before tax. That's a profit before tax. Profit before tax. You multiply by 0.8 to find the profit after tax. Then you divide by the number of shares. The number of shares is here. 190 divided by 0.5. That's the number of shares. I hope that is okay for everybody. I hope that is okay for everybody. If that is okay for everybody, then you can go. 158.2. 158.2. The profit before tax. Multiply by 0.8, divide by 3.8. That gives you earnings per share, and that's 9.09. So then that's 0.33. So the earnings per share is 0.33. So 3 multiplied by 0.33, the price earnings ratio is how much? 9.09. Now the PE for T is 25% more than this. How do we increase this figure by 25%? Well, we take this figure, multiply by 1.25. Multiply by 1.25. So the price earnings ratio for T is 11.36. Now, how do we find the value of equity of a company using the PE? You see, the PE that we have identified multiplied by the PAT. So the PE for T that you have calculated is 11.36. The PAT is 23 profit before tax and remove the tax, which is 18.4. So when you multiply these two now, you get the value of equity for T, and that is your 209.09, or just your 209. So what are we learning from here? To me, what you're learning is PE valuation. What you are learning here really was a PE valuation, full stop. So with that now, the value of T, let's even put that the value of P, T was PE multiplied by EPS. Okay, and let's put that was our 11.36 multiplied by 18.4. So that's what you have. Is that okay, people? Let's discuss the first bit. Are we happy with that bit there? Are we happy with that bit here?
Yes.
We are. I hope this helped you to reinforce your PE evaluation that yes, in this exam, we have to do our PE evaluation. Next, after this company, what you may pick from this question and use is that what happens afterwards may be different from what we saw in the other questions. What did we see in the other questions? When we combined H and S, afterwards there was just one company. When you combined M and N in the other question, afterwards there was just one company. But today there are how many? There are three entities that are arisen. And so we need to value this separately. And we say that for this one, we're going to use a PE valuation. For this one, we're going to use a free cash flow. And for this one, we're going to do an asset valuation. So what we're going to do is, let us go through this, the asset valuation, the PE valuation, and we'll leave that one out for today. Okay, there's some comment here. Let me check. So the type of valuation you need to use to answer the question is determined by the information given. Mr. Katele, yes. The information given will determine. And also the reference. For instance, free cash flow being mentioned, PE being mentioned, value of assets being mentioned. So, Mr. Katele, yes, you are right. As you read through, you start figuring out that what valuation methods are going to work here. I like your observation. So the valuation methods, yes, will depend on the information that has been given. Excellent. So now I want us to go to the various valuation. The one that we have not come across before, which we want to pay attention to, is an asset-based valuation, isn't it? How do we carry out an asset-based valuation? So let us go. Right, so this was our analysis here. Asset-based valuation. Let's pick the values that have been given. Let's pick the values that have been given, not number one. Now let me remind you, some of you may say, Mr. P, remind us, how does an asset-based valuation look like? An asset-based valuation will be structured as follows. You take the non-current asset, you add the current asset, you knock off the current liabilities, knock off the non-current liabilities, knock off any preference shares. So we take non-current assets plus current asset, less non-current liabilities, less non-current liabilities, less any preference shares. That's what you do. What do you use for values, asset values for this? By and large, we use a combination. So look at the net book values. If some market values have been given, use the market values given for any of these. So normally, by and large, we use book values when we're doing an asset-based valuation. However, if information has been given on market values or realizable values, you replace those book values with realizable values. Is that point clear? If we're doing an asset-based valuation, by and large, use the book values that have been given. And what you do is, if there's any mention on realizable values, use realizable values for the assets that have been given. So again, back to Mr. Katele's question. What you are going to do is determined by what the question has told you. If the question has not mentioned anything about realizable values, you just proceed with your book values. But if the question has given you details of realizable values, use them. So that is okay. Eh? So now, what information has been given here? The information says, it is estimated that for Department C, the realizable value of each non-current asset is 100%. And from this information given here, what we see? What we see is that 20% of our assets, 20% of our assets are sitting in Department C. 20% of our assets are sitting in Department C. The company has got Department A, Department B, and Department C. 20% are here. And 100% of their book value is realizable. For current assets, it's only 90%. So now they have given you this. So you're going to use this information. On top of that, the cost related to closing, we are going to spend 3 million. Now remember, he also says that from these values, we must remove the value of liabilities. We need to remove the value of liabilities, and they have told us that the funds raised from disposal of C will be used to pay off story companies' other non-current liabilities. So they are taking over some non-current liabilities. And that is why here we have said this was a non-current asset. 20%, all of it is realizable. For non-current assets, the realizable portion is only 90%, and we pick 20%. Other non-current liabilities, 20.2. The closure costs, 3. So post acquisition value attributable to Department C is asset plus asset less liabilities less the cost there, and that gives you 4.81. In the recent exams, the examiners have not been so much in asset-based valuations. They haven't been. But this is a structure of an asset-based valuation. This is a structure of an asset-based valuation. And in this particular question, this is what was needed. Are there any questions on asset-based valuation? Are there any questions on an asset-based valuation? Okay.
Mr. Perry.
Yes, sir.
Maybe I've not followed the language that the examiner used on the handling of the liabilities.
Okay.
Because for the assets, they had put proportions, but I can't link the disposals and the settlement of the liability. What is it?
I look at where I'm highlighting.
Yes. Mm-hmm. Okay.
Mm-hmm. So for Department C, what we walk away with, the value, is less that one. The funds raised from the disposal of Department C, which is the funds raised here,
Mm-hmm.
will be used to pay off story companies' other non-current and current liabilities.
Okay.
So remember, in our small format, we said you take so these two, that's their value there. Where is it? Let's go to our income balance sheet there. Let's go to our balance sheet. Let's come to our balance sheet. Have you seen other non-current and current liabilities for Tory is 20.2.
Okay.
What is that?
Yeah, sure.
It's important to ask every question. There's no need of running from question to question. It's better to take one question, understand it in full, and also say, what have I learned, which I can use on other questions too.
Oh, Mr. Piri.
Yes.
So this question is more of a merger and the reorganization at the same time, sort of?
Not necessarily. All we are saying is that after you have taken over the company, it's not necessary that you can keep the whole company. Some items you may get rid of them and just remain with what you think you need. To some extent, you can say yes. When you look at the concept called the topic of restructuring, you notice that one of the reasons why you restructure a company, it could be a company that you just took over. You just took over a company, and while you are selling C and you are spinning off B, they don't match with your strategy. So you just want to pick A. So to some extent, I would say you are right, and that statement you're going to find when you look at restructuring. Why do you restructure a company? Well, it could be a company that you just took over, and you don't need that particular component. C was not needed, and B also was not needed. Is that okay, Gilbert?
Yes.
All
Yes,
right.
please.
Yeah, let's be talking like this, then the session becomes interesting. You know, when somebody interjects, let's wait there. You know, I know that I'm not alone. Okay, let us make a move, guys. An interesting question. There's another comment here. Kindly go through how you have computed the asset valuation to arrive at 4.81. Okay, there's a question there. So here is the computation. So 19.64 plus 8.37 minus 20.2 minus 3. Please, can you check my formula there? I can also check it here, make sure that everything is okay.
Everything is okay. I was also calculating.
Okay, fine. We are going to end our session by us talking about this one now. Now, this one, you may say, Mr. Perry, that one we saw it under H and H. That's true. You know, have and stand. Flashback. Just flash back to, if you flash back to have and strand, remember that nice question you did? Have and strand, I'm sure you still remember your numbers. Have and strand. Again, we use a PE valuation. What did we do? We took the profit before tax. That's where we're starting from. Profit before tax. And what did we do with the profit before tax? We converted it to profit after tax. That's what we did. So we had the value there and the value there. Then there was some synergy, which we brought there. Then we had the total profit after tax there. Then we looked for PE of the combined company. And the question gave us an idea of the PE of the combined company. And that's what we brought here. And when we did the multiplication, we come here, we said we found the value of equity for the combined company. Okay? These are the structures we want to take to the exam. Because if you haven't done a question like this before, then of course you've been, because in terms of arranging figures, you've been in trouble. But when you say, look, wait a minute, in class we tried, we did something like this, you even put your small structure there and just fill in the figures. Even if one didn't finish, imagine you didn't finish, but the marker found this approach. An average marker of advanced financial management is a good teacher in financial management. So when he finds this, he even knows, this person knows what they are doing, and the marks will be given accordingly. In our question, did they give us these details? Let us see where these details were given in our question. Let us see where these details were given. So in our question, we go. Okay, so those details there, those details there. Let me pick my values. Yeah, here we are. It is estimated that the combined company's annual after-tax earnings will increase by 7 due to the synergy benefits. So you've got 7 here, which is synergy. What of the profit after tax of the combined company? What was the profit after tax for the combined company? Where is it? Let's go. Let's pick it up. For the individual companies, what are the profit before tax? No issues. Profit before tax, 158.2. Profit before tax, 23. But here, we only want profit for Department A. And for Department A, is simply 40%, 50%. So we are going to take 50% of this. So that plus 50% of this figure gives us the profit before tax. To convert it to profit after tax, what are you going to do? Multiply by the tax factor. That's what we have. So 158.2 plus half of 23 gives us profit before tax. And we apply our 0.8. We apply our 0.8. So let's go. Here we are, people. 158 plus half of that, multiplied by 80%. That gives us a PAT plus the synergy. So the total PAT of the combined company, PAT for the combined company is 142.76. So I'm going to say here, total PAT for combined company. Total PA for the combined company is what you have here. Then the value of equity How do you find the value of equity? The value of equity is found as, again, PE multiplied by PAT. PE multiplied by PAT. Where is the PAT of the combined company? Well, enough information was given for us to find it. Enough information was given for us. So let us look at the information which was given to us to enable us calculate the PAT of the combined company. The PAT of the combined company. Okay. Sorry, I was thrown out a little bit. Combined company. Let's go, combined company. After the acquisition, when department A becomes part of V, it is estimated that P company's PE ratio, that Vogel company's PE ratio will increase by 15%. So we need to take the current PE and multiply it by 1.15. That's what we are going to do. So what is the current PE of the company? If you remember, it's here, we got it. The current PE was 9.09. Remember? That's what we worked out, that the current PE is 9.09. Here we increased by 25%. But now they say this figure increase it by 15%. So we multiply by 1.15. 1.15. So let's go. We have the answer there. 9.09 divided 1.15. Multiply 1.15 gives you that. So that's the PE of the combined company. That's the PE of the combined company. So if you multiply that by that, we have the value of equity for the combined company. So that's your value of equity for the combined company. Where do we take these two values? Well, we go back to your format. You go back to your format. And in your format, you say, we have these two values here. We have these two values. These two values, we have them. So this, here we are. So in this question, this afternoon, we have seen an asset-based valuation. We have seen a PE-based valuation. And we have seen what may happen after an acquisition, that it's not just one combined entity also. No, other entities may be disbanded or unbundled. That's what we see. Okay, people, that's where we leave it. Tomorrow, I want to conclude that story. There's a bit of some Mickey Mouse free cash flow to equity. So I want to review our free cash flow to equity on that particular one. Okay. So that's
Mr. Perry.
Yes, please.
I've got a question from the previous question that we dealt.
Which one is this one?
Strand
Yeah.
is where I need to seek clarification somewhere.
Yes, please.
Just a minute. Let me just try to open it. I was going through it.
Yeah.
But somewhere where I didn't understand. Under the last part, where we were analyzing the offers that the various offers, but now the last offer, where there was cash, the bond.
Yeah.
Yeah, that's where I was not clear on those calculations. How we got 10 over 20.
100 over 20 here.
Yes,
Check my screen. Check my screen.
Okay. Okay. Yes, right there.
Mm-hmm. So which one was?
So I didn't understand how that calculation was done.
Mm-hmm.
I just going through my spreadsheet.
Okay.
I couldn't pick it.
Okay. So it's here. So I cut and paste. So here the offer was what?
1.25, which is there.
And what else?
Okay. Plus one of $100, 3% convertible bond.
For every how many shares?
$5 nominal value.
So in here, in $5 nominal value, how many shares do we have? So how many shares are represented by that? I think that's where the question was. The question is, how many shares are being represented? So what's the nominal value of a single share? What's the nominal value of a single share? So you need to find out what's the nominal value of a single share from the information that we got.
Okay.
So here, there's no issue. Don't panic. It's here, 25 cents. So these shares are 25 cents. That's the nominal value. When you come here, then we divide this by 25 cents. We divide this by 25 cents. That will give you
20
shares.
Mm-hmm.
So it's $100 that we're offering you for 20 shares. And that is why here we are saying what?
100 over 20. Okay. I understand now.
Well done. Excellent.
Thank you. Thank you so much.
Good. I'm happy to see that people are going through this way. You know, on this course, sometimes it's not in the number of questions that you tackle, but it's how well you understand the questions you have done. That is very important. And ask yourself all the time, what have I learned from this question? What have I learned personally? So to me, that is very important. Any other questions? Today we have covered asset-based valuation and P-based valuation. Are there any other questions? Okay, so tomorrow we want to conclude. And as we conclude, we also want to start another question too. I'll share the question. It's one of the questions which is here. That's there. I'll share this question too. As we conclude and as we move to financial risk management. Okay. Yeah. And now the students who are taking junior exams, One of you made a comment that, Mr. P, some of us were lost on ungearing and regearing. So I told your colleague that hold your fire. If ungearing and regearing cause you trouble, as soon as we finish, when our friends from lunch branch off, as we are back to again the basics, the cost of capital, investment appraisal, where you're going to pick the balance of the skills. But here's my encouragement. I would want all of you to pay maximum attention to financial risk, so that whether you're writing in March or June, financial risk must deal with it once and for all. So even that as we start another cycle for the June exams, you must tell yourself, I've got my financial risk within my bank. I hope that is clear to all my June candidates. Okay, so we meet tomorrow, people, 16 hours, as we continue with our valuation topic.